Hello, I'm Tony Kay. Welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist. Hi, Evan.
Hello, Tony. How are you?
Yeah, very good. We've ticked over to the 1st of November. What's in store for this month?
Yeah, November's an interesting one. I actually call it the sign-off month, and the reason for that, December always has a boost. It's an economic driver, Christmas clearly being part of it. Consumer confidence goes up leading into it. People tend to do that spending, and not only that, January is the opposite to that. Everybody's still on holidays. You always see a drop seasonally wise in net exports activity in general. So those 2 months are really hard to gauge, and you can almost put them and try and smooth them out with seasonality, so you can leave them to one side. But November is still a normal month, and it does give you sort of an example of what you may get in February and beyond. Also what this year has been. Looking at what you would probably expect coming out of October leading into November, retail sales come out on Friday. They'll be okay. And I think that needs to be probably just put into perspective of the fact that confidence finally broke out of its pessimism in October. Expectations have been slightly moved up to 0.4 of 1%. But if you look across the year, retail sales have grown at 0.3 of 1% month on month on average. That's pretty anemic. And you're not seeing any sort of major change there. We know, and we've talked many times on this program about what's going on with consumption, what's going on with the consumer, because that will be the theme, I believe, of 2018, is the individual versus the corporation. We know that business confidence is up, and you'll see that in November again. It's been a pretty good October. I mean, the market is telling you that clearly. It's been the best month of the year in the ASX. We're now touching a 2.5-year high. Business profit is doing quite well. We're going through bank season right now. They're also telling you from their loans, although it's not growing at what it was 2013, 14, 15, still very, very strong. So business is doing okay. It's the individual. So I therefore look out for things like employment numbers coming out next week. They continue to really go quite strongly, but wages aren't moving. So all of that comes out in November, and it's a real sign off to what the year has been. They will be solid, but I certainly wouldn't say they're working in unison. We know that, and whether or not you can actually see it breaking out next year as well.
Yeah, we've got all these dynamics at play as always, and heading into Christmas will be interesting just to see how that confidence plays out into that in terms of retail spending.
Yeah, I would also look at other things that are now coming through. So looking away from the actual physical economic data, look at feeders. And what I mean by that is look at macro overlays like the dollar, look at things like net exports, look at things like commodity prices. So those three in November you need to watch. Reason for it, what happened the last month, in October around inflation has clearly put the Aussie on the downside. So next week when we get the RBA, have they sprouted wings again, turn themselves dovish, which suggests they're moving away from the idea of a hike. Clearly, if you had looked in September, everybody was getting really bullish. There was even two, retail banks, ANZ and NAB, suggesting that next year there'll be 2 rate rises. NAB's got 4 over the next 2 years. Clearly, that's going to be revised down. So they're an interesting one because they've now got a negative Aussie dollar side, and what we know, but what we haven't talked about enough yet is the US dollar side. The US dollar has been quite weak over the last 3 months, which is quite interesting. I know we don't talk about the euro or about the pound, but you need to look at them. They've been strengthening quite dramatically, and that therefore means the US dollar is weak, and it's probably ripe for a bit of buying. We've got a new Fed chair being announced this week, most likely Jerome Powell. The reason I'm talking about the US dollar is that it is likely to get a bit of a bid pickup, and that's more downside in the Aussie. And the reason you want to therefore look at that gets back to those other 2 points. Commodity prices. Commodity prices are actually holding, despite iron ore, which is as expected on the downside. Everything else is holding. So all of those are US denoted. Net exports, most of it is done in US dollars, considering what we export away. So there is a kick there that if the Aussie was to fall to 75 cents, even as low as 74.5, some people are forecasting, there is an economic benefit to that. So that's one to watch, and that's an interesting one. Commodities need to hold to do that. The other side of that, and around the consumption side, the question therefore also becomes whether or not that lower dollar gets confidence. So you actually see more wealth coming into the country, repatriation of these monies back, filtering through firms. That hasn't happened yet, and that's the other side of this question. So it's a positive for other major net exports, tourism, education, materials like that. They get a kick out of also a lower dollar because you get more tourism, you get more education dollars coming in because it's cheaper to use Aussie denoted products than US denoted products. So the currency for me is key here around whether or not the RBA can say we're out of the market still, we want the Aussie to keep falling, it helps growth, it helps net exports, and that therefore gets back down to whether it can filter down to the granular level and hit you and me.
Yeah, and the other factor I suppose we haven't really talked about is rates. Now, we're not expecting anything to happen this year, but in the US, it's a different story, especially with a changeover at the Fed, what that may do.
Yes.
Probably not a lot of more lever pulling on rates there.
No, but the catch with the US situation, and the great thing about the US Fed is that it's so open about where it sits and how it forecasts the market. And when you look at all economics anyway, you have to always look at the US because everything is, in FX land, everything's two sides. There's the Aussie US or the pound US, etc. And the US is normally the denominator in most of these. So you've got to have an opinion on the US and you've got to understand it. So the Fed is telling you that they are currently forecasting 3 rate rises next year. The market's only pricing in 1 3/4. Guaranteed to come in December, according to the market and also to the Fed. So there is a discrepancy there, and that again gets back down to if Jerome Powell is the guy to take over from Janet Yellen, that happens in February, he is likely to follow her mantra and pick it up and go with it. There is talk that he would be a bit harder on regulation, particularly around what the Trump administration wants, but in the main, if they do follow through with where they want and they tell you on their dot plots, that's a US dollar buying opportunity. That therefore is a negative for the Aussie dollar. So it gets back down to what we just discussed is the advantage for us is the Fed moving because the RBA, as I've said many times on this, is out. They are clearly telling you household debt, household spending, etc. is fairly anemic. We know that wage growth is anemic here. So their ability to actually pull the lever because inflation is moving to 2-3% is very, very remote. So we can't talk about the RBA at the moment because the RBA is sitting on its hands and probably is going to do so, I believe, anyway, all through 2018. So the other side of the equation is what happens in Washington and therefore what happens with the Fed. They are the white knight and whether or not our Aussie dollar goes lower. Everybody's been saying that for years and I agree with that. It's just the difference now that's happened, particularly in the last 2 months, is it is very clear that the RBA, as they've said before, are different to their international partners. They're not like the Bank of Canada. They're not like the Bank of England, blah, 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 because we didn't have to do anywhere near the amount of lever pulling that those kind of banks did. And therefore, we will move things domestically. So they're out of the equation. It's the Fed. And the Fed is the most hawkish bank around. I know that's hard to say considering the kind of people there, but they are the only bank that are actively moving rates to the upside. And that therefore gets back down to that principal idea. Commodities are in US dollars, positive for us. And if we can get that coming through into other products, tourism, education, those kind of parts of the economy that just need that kick, that could see 2018 be a bit more exciting.
We'll see what happens, Evan. Thanks very much.
Thanks, Tony.
We'll see you again next time on The Economic View.